Hello, everybody, and welcome to our Investor Insights, which we do every 2 weeks online with one investor and a self-selecting group of entrepreneurs and investors. Since I see that Joseph is here and he's an investor, I'm Bonnie Halper. I write the weekly Startup One Stop newsletter. I'll put the link in the chat. And we want to thank our guest is Jason Klein, who has on-grid ventures. He runs the Harvard Business School Angels in New York, and he's a member of the New York Angels. I'll tell you more about that in a bit. And we want to thank Joseph Katz for hosting us and being our sponsor. So Joseph, tell us about what you do.
Good morning, everyone. Thank you, Bonnie. Welcome, everyone. Thanks for those on the West Coast for joining. I know there's some early risers here today. I'm Joseph Katz. I help early stage companies build go-to-market strategies and go from unknown to well-known. And if anyone needs help with their business, happy to jump on a call at any time. My information is on my screen, but I'll also post it in the chat during the call.
Okay, I always forget to mention that I also help founders with their pitch.
Bonnie, you're frozen.
I thought it was me.
The attendees introduced themselves, so up to you. But
Bonnie, you're breaking up. I can go I could take the on, so to speak, and go around the horn. Shelley, please introduce yourself and tell everyone who you are.
Jason? Oh, okay, thank you. I'll shut up my video.
It's amazing when you think after all these years, we're still having challenges with Zoom, yet it brings us all together from all points of the world. I'm really happy to be here. Joseph Katz invited me. I know Janice and some of you, and I'm really excited to learn more about your organization. I'm a storyteller, and I help people tell stories through public speaking. And I'm really excited to be here. So thank you for inviting me, Joseph.
No problem. Janice, you're next on my screen. You're on mute. You're on mute, Janice.
Boy, this for me, I'm the West Coast person, so it's 6:40. Thank you so much for having me. And Shelley, good morning. It's nice to see you. And I am an inventor and entrepreneur. I reinvented the pillowcase, and I just received my utility patent on this. And I launched in June of 2022, so I'm still pretty early, but I have grand ambitions to take over the world and to be the Kleenex of pillowcases. So when people think of how to transform your comfort, they think of my company called Towsey Brands. And I look forward to this. I'm excited to be here. So thank you for the invitation.
Great to have you. Michael Florentino.
Yes, Michael Fiorentino. Yeah, I was recommended to come here by George Lucarezos, who is a mentor of mine, and we talked about some of the IP I've developed. My background's in programmatic advertising from New York City. I kind of live between Lisbon and New York now in Portugal. Reason being, I'm very into progressive European data policies, and I see that regulation's becoming a hot topic. And about 4 years ago, I submitted a patent that covered where I saw new decentralized ecosystems going and this new form of social TV that I designed. And it actually turns out that the underlying AI and streaming NFT system might be the big thing that gets me funding. So I'm just here to hear what the community's up to and meet some people. And I'm happy to talk more about that if you want to contact me separately.
Welcome. Sam.
Yes, I'll come off. I'll see if my camera is any better now. Great to join the call. I'm in Buenos Aires right now, although usually based in Boston. I run a 25-person company that is focusing on AI applications in the video space. We've mostly bootstrapped the company, although we did raise about $500,000 of equity crowdfunding and did some accelerators as well. And happy to say that we're cash flow positive and growing. And it's a good year for us because everyone's buzzing about AI. So hopefully we don't get steamrollered by the people putting, billions or trillions of dollars into AI. But we think we have a pretty good opportunity, and we're getting some great customers. So that's us.
The next introduction is a great connection to AI. Tom.
Thanks. I'm Tom Kwak. I'm a data scientist. A couple of years ago, I co-founded a company in the insurtech business, solving business problems using AI. Last year, we got acquired by CCC, and now I'm leading AI innovation in the subrogation field.
And our next guest also has something to say about AI, I am sure. Joseph Chan.
Hey guys, good to meet all of you guys. I'm a real estate and early stage tech investor. I invest seed to Series A, usually B2B North America focused. Try not to do hardware, biotech, or direct consumer CPG, but everything else is fair game. Pleasure to meet you guys.
Allegra.
Hi, everyone. My name is Allegra Jesse. I am thrilled to be here and excited for the invite. I connected with Bonnie on a presentation that our company Simile made last week or the week before. We are trying to revolutionize, how authors get discovered through self-publishing. And so we created a self-publishing platform that focuses on fiction, focuses on connecting readers with writers, connecting the right readers with writers to help boost their discoverability. And for the writers who want to be published traditionally and see their books in bookstores, we hope to be the site and the platform that elevates them to have those opportunities. So thrilled to be here and excited to be part of all of this.
I told Jason you would be here too.
Buzz.
Hey guys, Buzz Hofford here. Thanks for inviting me to join my first time in this meeting. I'm just currently, I heard about this through TagFi. I was approached by TagFi. I'm not sure who on this call is.
Me.
Bonnie.
Bonnie, okay, great. Well, thank you for the invite, Bonnie. If you find me on LinkedIn, I'm known as the Sustainable Food Guy, and I'm looking to probably create a YouTube presence around that moniker, basically helping educate people on where their food comes from, how they can help improve our food system. I've been running the Sustainable Foods Network on LinkedIn for several years, and that's got about 25,000 members. So I think we're kind of growing. It's a hot topic right now. So really looking to leverage my experience in the industry, and happy to talk with anybody about it today or later.
Oh,
Thanks
yes,
for having me.
please put your contact information in the chat.
Yes, I will do. If I can figure out how to do that.
And Mr. Byron. Byron, you're on mute if you're talking.
Can you hear me?
Yeah, now we do.
Okay. Sorry, my video isn't on. I'm in transit to our office. But my name is Brian Pearson. I run a tech startup called ED Brain. We partner with colleges across America to build official off-campus housing marketplaces. And it is on their domain, their .edu email address. You can only use it if you have a .edu email address. And our specialty is our student support. We have a program that helps students build credit paying for rent off campus for free. We have 20,000 scholarships available for free. And we have a program that waives the security deposit without sacrificing damage coverage to the landlord. And we are an enterprise platform because we're helping 50 plus unit apartment buildings rent to college students in partnership with that college.
And PJ, bring us home.
Hey, I'm a longtime attendee of these SOS meetings. I've worked in diversity, finance, engineering, natural language processing, and AI. Thanks for having me.
Great. Jason, the floor is yours.
Okay, great. Well, a pleasure to get to talk to such a interesting and diverse group of entrepreneurs. It's always interesting to talk about fundraising because there's such a variety of advice that's out there. And so I love have a short deck to go through that will just talk about kind of my own views of things and my own experience. Hopefully you'll see some things that are maybe contrary or different to what you're hearing from others, but hopefully you'll be able to take some good things away for this. Let me go ahead and start my screen.
Please talk about your background too, because in investing, because you're a very active investor.
Yeah, I'll talk about that here. So yeah, so you see that okay? So I wear a bunch of different hats. So so On-Grid Ventures is basically my personal investing platform. I've got investments in almost 30 companies and lots of follow-ons on top of that. Some I've made kind of on my own, but maybe 2/3 are through the various angel groups that I'm involved with. I am president of the Harvard Business School Alumni Angels Association, which is a global group with now 19 chapters across 4 continents. My co-president is one of the former heads of the Silicon Valley, Northern California chapter. And I'm also chairman of New York, which is the largest chapter that invests about $3 to $4 million every year with monthly pitch nights here in New York. I've also been very active in New York Angels for over a decade. That's a great group, lots of very experienced investors in that group. And also I'm active at some level in Dartmouth Alumni Angels, and also a nascent group called Marvin's Angels, which honors Marvin Bauer, who was the founder of McKinsey. And it's a group of McKinsey alumni that like to invest together. They tend to go a little bit more later, later stage. And so I have a number of different hats right now, but I'll also say my career is, before these past 10 years, has been almost entirely in the media, consumer and media industry, and some different operating roles. But in some ways, aside from my time as a magazine and newspaper executive, probably the role that sort of informed my investing more than anything else was the 2 years I spent after McKinsey overseeing strategy for a $1 billion division of a media company, because I did about 15 acquisitions, and they were all entrepreneurs like yourselves that had built companies from scratch, and they were all acquisitions, pretty much under 100 million, in the 10 to $100 million range. And the reality is, if you're an angel investor, that's the sweet spot for exits. And so I got to see a lot of stories of successful entrepreneurs. The nice thing about being an active angel investor is you do not need to have a $1 billion exit to be successful. And so the sweet spot are 50-ish $1 million exits, where there are a lot of them. And so that kind of helped get a decent perspective on this kind of early stage world. I'm happy to break take questions as we go, but I certainly will leave a lot of time at the end to talk about various aspects of this. So let me go ahead and get started. So where do you start if you want to fund your company? I guess many of you have kind of gone through this. The main message is that you really want to start with your own capital and your own resources. I think every experienced angel will talk about, entrepreneurs having skin in the game. You don't need to bankrupt yourself. People may be at different life stages. It's interesting. I'll just remark, I had done some things, looked to buy a company in private equity. They will often, some of the private equity firms will not back you as a CEO unless you literally show them your net worth, and they sort of want an appreciable percentage of it to be sure you've got skin in the game. Angel investing isn't quite like that necessarily. No one will ask to see your bank statements, your personal bank statements, but it is generally expected that the entrepreneur will put some skin in the game and as a way to get started. So my point though is, what do you do after that? And I'd say in many cases, you probably just want to stop. I mean, I've seen, and I will tell entrepreneurs this, there's certain businesses that are just not suitable to outside capital. And that from a good and a bad standpoint, I'd say probably half the entrepreneurs that we made wealthy a couple of decades ago didn't have any outside investors. Self-funding was much more common, and building a company over a 10 or 15 year time frame. When you kind of get out of this tech world and you look at kind of more classic entrepreneurialism, like a Mike Bloomberg, for example, it's more of doing this for the long haul. And then the classic exit is when you want to exit from lifestyle reasons, not because you need to from a financial standpoint. And so in many cases, you really don't need the hassle from outside investors. And so we can talk more about what are the characteristics of that. But the main thing is, if you can get your business to self-funding, it's often a good thing, to do. And so it's a very different, a different path. Next, you'll go to friends and family. And I really want to distinguish this from angels. People will call these, the word angel is kind of overused. I've made what I call friends and family investments. It's really very different. You tend not to even look at the deal, the term sheet or the documents. You don't really even understand the terms of what you are investing in. The early friends and family investments that I made, I didn't read the documents, and I never understood exactly the terms. And so it was really much more of a sign of faith and backing a friend. And, that's different. But when you start dealing with angels, then you're kind of entering a bit of a different, a different area. And that's what I want to talk about, and also talk about VCs and some of the differences between angels and VCs. Let's start with angels. Angel investing is a big force in this country. It is not limited to San Francisco and New York. It's coast to coast. I've been active in the Angel Capital Association for a number of years. It is a national organization. It's got a lot of people from the Midwest. It's been around for a while. A lot of these 300,000 angel investors are investing in kind of low tech and heavy industry and typical retail businesses. It isn't just investing in tech, tech startups. I'll show you some data which will give you a better sense, but the way in which, if you look at angel investing across the country, it's kind of very different from the kind of the tech-oriented angels that dominate kind of Silicon Valley at this point. So there's very different brands of angel investing. And so all angels are not alike. So you've got individuals, you've got what I'll talk about as professionals, and then you've got, angel networks. So individual angels are people that have only occasional deal flow. They hide under rocks. They can be kind of hard to find. They may not necessarily be looking that carefully at valuation. They're doing little diligence. They're probably hoping they'll put a check in, and they're figuring that you'll either be really successful and they'll have a huge success, or it'll be a flop. And so they're also probably not being very, very methodical about doing this. I'm not talking about super angels, which are a bit of a hybrid, but probably in both coasts, these are the people you'll probably run across. And they'll have a bit of a different flavor of things from what I call as professional angels. And, to me, a professional angel is someone that's got kind of a larger deal flow and that cultivates it. It could be a super angel. They are going to be sensitive to valuation and terms because they have, if they've been doing it for a while, they have some experience and they've seen how companies evolve and they've seen investor protection in force. And so they have some real firsthand knowledge of what it means to put certain terms in. They will do real diligence. The data is 20 hours of diligence is what real angels tend to do on average, which is a lot. And so, I'll talk about angel networks in a moment, but that's why many angels kind of gather together in networks to help with diligence and help with their, reach. The key thing is they're looking to build a portfolio. And so if you, the ACA, the Angel Capital Association, I mean, they've got people that'll do Monte Carlo simulations and they collect data on all this stuff. And the reality is you need a portfolio of between 10 and 20 investments, given the dispersion of returns, to have a positive expected value. If you're looking for kind of $100 million exits, a 10 portfolio mathematically can get you there. If you're really going to shoot for the fences for $1 billion exits, you need to have 20 to have any kind of problem. You may not get $1 billion exit, but at least to have a positive expected value. And so if anyone's really serious about this, they'll be making multiple investments. They'll be very keen on trying to keep their per investment amount down probably to something like 25,000 so they can build a portfolio over time. You can often find them in AngelList or Crunchbase. Bonnie certainly knows a number of them. And they do want to be active and want to help in ways that are much more beyond, beyond money. And they will tend to follow. I think good angels will stick with you and we'll certainly put that second check in and maybe more beyond that, depending on evaluation. And so, angels do add value to companies. And so this is Josh Lerner. He's kind of the senior professor of PE and venture capital at HBS. And he's actually done some research that talks about how if you have an angel investor, you actually have an 18% higher success rate, 16% to have a successful exit. So they do tend to make a difference in terms of helping you with your company. So angel networks, like a New York Angels or an HBS Alumni Angels, will have a lot of deal flow. They will be sensitive to valuation and terms. I'll talk about that quite a bit. There will be real diligence at 20 hours.
Thanks.
Yeah. I would not, it's a mistake to think that you're going to get more money from a VC, because the reality is, seed VCs these days are putting maybe $100,000 checks, maybe $250 into companies. New York Angels, I'm just about to close a round. We're putting $500,000 into a company and leading the round. And so a lot of these angel networks are putting more capital in than VCs are and can be more active because they'll have a lot of people in that round who'll be looking to help the company. Some do like to lead rounds. New York Angels is certainly one of those groups. And both my groups have done rounds, including HBS, have done rounds of over $1 million. And so, and I'll also add about angel networks, it is a myth to think they take longer than VCs. Most VCs will not write a check very quickly unless the round is pretty much as a leader and good momentum, and they feel they're going to lose out on it. And they're investing based on, FOMO, the other guy. Most VCs will take months to make a decision. They will want to get to know you for quite a while and follow your effort. And angel networks actually can move pretty quickly if the deal has got suitable momentum associated with it. I think you'll find an angel network will actually move much more quickly than a VC can. And also just a little bit of a plug for HBS Alumni Angels. We have 19 chapters. The URL, it's kind of hidden, but it's just hbsangels.com. And if you're interested in applying to capital, I mean, just go to hbsangels.com and then find this page, which is the chapter tab, and then you have to apply through the individual chapters. So each chapter invests independently. And so what I would suggest is just find the chapter that is nearest where you are, go to their website and invest through their, system. A lot of chapters are taking investors out of their own area. I mean, that's pretty much a moving target given COVID. New York will certainly invest in entrepreneurs from elsewhere, but increasingly, we do like to see people pitch in person. Since we reinstituted that about a year ago, we've begun to shrink back to a New York focus, but it's still a bit of a hybrid, these days. And HBS Angels has invested close to $100 million now globally, so it is a pretty significant group. Okay, leading around. You all seem to be fairly experienced, so maybe this won't be that news to you, but a lot of new entrepreneurs just really try to ignore this business of getting a lead in their round. The key to being a leader is you need to have followers. And so what the lead investor will do is negotiate terms on behalf of all of the investors in the round. They will conduct, they generally speaking, should be conducting legal review of the documents, which usually the company itself will pay for. And a lead investor will, is going to write a meaningful check. It may not be dominating the round, but it could be, it could just be 25% of the round, but it should be a pretty significant check associated with it. And it's amazing how many entrepreneurs I run across sort of, don't have a lead and don't worry about it too much or don't focus on it. But the reality is that you really do need a lead investor. Your round will proceed much more quickly with a lead investor, and particularly a lead investor that will set terms and establish a pace for the round that other investors will follow. Someone can't just declare themselves a lead. In these cases, I've seen a number of situations when you have non-traditional investors leading, meaning someone who doesn't have a VC background. They may have a VC name, but they're probably managing a pension fund or something from some other industry. They're not familiar with the current market for valuation and terms. They'll establish an unrealistic set of terms, and the round will sort of stall. And so, as I said, the key to a lead is having a lead that will establish terms that will allow you to complete your round expeditiously. Because as any kind of founder, the last thing you want to do is be fundraising forever. So it's really key to have a lead investor. Can I pause on that? Does anyone have any questions or comments on that? Because
yeah, I'm curious. What's the best way to find a lead investor?
Good question. In many ways, you do some of the same things that you're doing to find, I'd work through angel networks and seed VCs and super angels. You're still going to do intensive networking. But when you think about how much time you spend and how you allocate your time, just ask. Is it possible that you might lead this round if you like what you hear? And just be sure you focus your time disproportionately on trying to find a lead investor and really working with them. And also realizing that, the round will move so much better if you can trust your lead investor. Now, as I said, you'll see here, you're going to get some different advice from me than you may get from others. And so you need to sort of be simpatico with what you're hearing, because as I said, there's a lot of bunk out there about raising capital. It's really about putting, again, it's always going to be a lot of lead work, but it's about just finding someone that you develop a relationship with and can trust. And we'll listen to their advice when they come and say, you need to change this deal term or do this or that. You'll have, you'll listen to them, as well as obviously when it comes to operating the business, you listen. I think that's the key thing. I think just being, you don't have to always agree, but you'll listen and give them a good audience when they have suggestions.
Jason, before you go on to the slide, can I ask one more thing about
Sure,
the lead
yeah.
investors? Are they ones who generally will also assist in bringing in other investors?
Absolutely. Yeah, the lead will. And look, my angel groups, for both of the angel groups we have, once they like a deal, there's lots of people, lots of other groups and individuals that we can refer a deal to. In fact, with HBS Angels, we actually have a global syndication program that has certain thresholds. So if we have a deal in New York that meets the threshold, and the threshold in some is real simple. There's got to be a certain number of investors and dollars associated with it. And there's got to be enough time, basically, to syndicate it. Then we'll syndicate it globally, which is we'll hold a webinar, we'll publicize it around the globe and to the other chapters. I mean, and in those cases, those companies have almost always raised at least $100,000 or $200,000, and some companies have raised more than $1 million, through that program. There's other angel groups in New York that we're very friendly with. I mean, they're all eager to take our referrals. I mean, they're frankly, they're bugging us continuously to send us, deals. And so my two groups tend to be stronger groups, meaning that when there's a company we like, we have a lot of investment capacity. So often we'll end up completing the round, but if we don't, we'll certainly help you, finish the round and make referrals. And so that's one of the reasons why, getting a real good lead is really so, so critical.
Thank you.
Yep. So also the way to think about angels conceptually is not as friends as family. Again, this is a little bit of a conceptual break, because think of them more as mini VCs. Because if I wouldn't look at angels that you come into from New York Angels or some of the more sophisticated angels in the HBS group. They will be operating like mini VCs in terms of how they look at the deal and how they want to help the company. The big difference with VCs is that they're investing other people's money, and as opposed to angels who are just basically doing, investing on their own, on the own behalf. And as I'll talk about in a minute, the economics of investing other people's money are very, very different sets of incentives associated with that. A little bit about VCs, just, a lot of you maybe have some experience, but just as the way it typically works is, the VC that you're dealing with is probably acting as the legal general partner that's got ultimate liability for what the firm is doing. They have limited partners that are pension funds or wealthy individuals that are putting money in. They're all minority partners. And the GPs got a pretty good deal. They're taking 2% of funds managed off the top every year. So if you're looking at a fund that's got $100 million invested, they're taking $2 million a year in fees out of that. And so that's a pretty darn good deal if you can get it. And they get carry, they're sort of getting a free ride. Once the LPs get their initial money back, again, depending on the terms, they'll typically get 20% of the profits. But the data shows that VCs on average get basically 2/3 of their income from the management fees. That 2% fee is 2/3 of what they get, and 1/3 comes from carry. And so it's a myth. I mean, Professor Lerner will talk about this. He did the research on this because the numbers are somewhat similar for private equity. What he says, he's going to be pretty funny with it. He says he's been teaching PE for 20 years, and he's been lying to his students for 15 of those years. Because he's been teaching his students for 15 or more years that you're aligned, you're totally aligned with private equity, be it LBOs or VCs, because of the carry. And then he ran the numbers and he realized this is not true, because they're only getting 1/3 of their profits from the carry. They're mostly getting money on the fees. And so they're basically fundraising machines more than their capital deployment. And so it's a very different set of incentives. Tom, you had a question?
Yes, so this is probably like a broader question, like what
Yeah.
you described about the incentives of the general partners, etc. Of course, one question that comes up is that like what's in it for the LP? It seems that GPs get like the better deal here, but beyond that, how does this affect our choices as like early startups? Between going to an angel versus a VC, should we propose like different things when considering the very different like incentives of the decision makers?
Yeah, I know that's a very good, that's a good question. I think the first thing you really want to do is you want to focus on getting a lead. And that'll either be basically an angel group or a really super angel. Or a seed VC. And, like I often tell entrepreneurs, if you know a VC that will lead you around based on a phone call and a prior relationship, I mean, do it. Save you a lot of time, but a lot of people don't. And you can spend an awful lot of time, running through, VCs and holding their hands and, you can spend 8 weeks with the VC and then they'll just sort of ghost you like a date and they'll stop because they can be very, very different, different beasts. I think it's a question of just trying to find, as with angels, I think you want to qualify people, simple things like, it amazes to me how many entrepreneurs will kind of bowl me over and start talking to me, and they're doing something like, say, cryptocurrency. Well, I will not invest in cryptocurrency at all, and so I won't spend any time with it. And so you're wasting your time with me if you're going to talk to me about your program. I mean, those sectors that I will invest in, and VCs are the same way. They all have sectors that they'll invest in, but they won't tell you. I mean, they'll tell you a little bit, but they'll tell you really vaguely because none of them have got strict rules. They'll all have some variation around it. And you can spend an awful lot of time with if you're a cybersecurity company. And my daughter actually is starting a cybersecurity company with VCs that, they don't want to rule out cyber, but they really don't understand it enough. I mean, they will spend an awful lot of time with you and then eventually say, well, we're really just not comfortable investing in cybersecurity, after 8 weeks, and 50 hours of discussions. And so I think in both cases, you just really want to qualify people first to understand that, it really is an area in which they're going to invest. And particularly, and I would say it's really sector and stage are really the most important things. And if you're really, at a business plan stage, you really want to qualify people that will invest at that business plan stage.
Makes sense.
And just a little bit of data here, but just to show that most rounds are syndicated. And so it's really not a question of either or, 29% are syndicated with angel groups and VCs. Angel groups themselves will syndicate it. Angels will only do angel-only rounds are 32%, and then VCs only are just 7%. So VCs will almost always have some angels involved in the round, and so it almost always is the case you're going to have both that are kind of blended together. Anyway, here's the data I just spoke about from Professor Lerner. VC partner income is 62% from annual management fees. And as he notes, angels are investing their own money, and so they're less prone to what they call agency problems. There is much more alignment with your angel investors than VCs. The compensation structure often leads to excessive fundraising and suboptimal investment and exit decisions. Every time you take a VC round, it's a reset on your exit. And so, as an angel, if I invest at a under $10 million valuation, then I'm typically going to target a 10x return. I'm pretty happy with a return anywhere under $100 million exit is fine with me. But if you're going to raise a round at a $25 million valuation, then the VC is going to start looking for much bigger exit multiples at that point. And if you're lucky enough to raise a round, at a $400 million valuation, it's a great thing to do, but it can be kind of a curse because the VC will not want to drive you to grow your business so he can get a better exit. And I can give you many examples of VCs that have killed companies, or wealthy, very wealthy in angels that have killed companies because they invest. The entrepreneur thinks they're doing great because they come in with a great valuation and relaxed terms. The entrepreneur's throwing money at them. And one of the biggest mistakes, I'll talk about this, you could make is spending money too quickly and wasting it. And so a lot of wealthy VCs have driven companies into the ground because they've pushed them to deploy capital faster than they can really expand prudently. Because of the fundraising structure. The VCs are fundraising and deployment machines are not necessarily terrific at getting returns. And so the data is that more than half of VC funds deliver low single-digit returns, 20% of funds deliver actual losses, and only 20% achieve 20% returns. That's from Professor Lerner. And then you look at what was published on the right. This is from just TechCrunch. Basically, they report that 50% of returns are less than 1x and only 5% are returning more than 3x. And so VCs, it's very hard to find out accurate data on VC returns unless you're an investor and you really scrutinize the documents in great detail, because when you actually look at the real data, you see numbers like this with big dispersions of returns. And so lots of VCs will make you think they're great investors. Up until a year or so ago, a lot of VCs looked like great investors because of the mark-to-market abilities and the inflated marketplace. What you need to see is realized returns as opposed to the paper returns that they often have, and they can really very much be very different. I'll also make the distinction between angel and seed VCs and other VCs. And so this is something also a lot of entrepreneurs don't really appreciate as much. A real seed VC is focusing on this round. They're deploying the bulk of their capital at this round. A lot of VCs are going to deploy the bulk of their capital in later rounds, and so they see this round as a placeholder. And so, just any of the big West Coast VCs, like an Andreessen Horowitz, there's no way they've raised billions of dollars. They're not seed investors. They may give you a check in a seed round, but they'll sort of throw that out there. They're deploying most of their capital later. And so they're not really focused on valuation and terms. It's a great name to have someone like that in your round, but the signaling value to others may not be as big as you think it might be. And certainly, in fact, there's often can be negative signaling, because if you're going to get a check from a big VC in your first round and they don't lead your next round, that's a really bad signal to other investors, and that may end up hurting you than helping you. And so if you find a really committed seed VC that does seed VC for a living, and they're hard to find because it is not the way to get rich. You want to get wealthy as a VC, you may start in the seed stage, but every fund is going to be bigger and bigger, and you're going to gravitate to later and later stages because you can't deploy $100 million as a seed-only VC. You've got to move into later stages. And then the alignment with you as an early stage entrepreneur gets more and more distant from where you are.
Jason, I have a question on that. Does the portfolio of an investor want to be like, somebody's personal stock portfolio, where you have aggressive investments and then you have your bonds and your safe investments and long-term investments? Does that mentality translate to VCs?
No, I don't think so, actually. I think with I think what you'll find is that the VC has got kind of a philosophy around investing. And if they're a later stage VC, it'll be a certain philosophy around what they do as an early check and what they do as a later check. And that's what will be kind of much more, fixed. A lot of the bigger VCs, the partners can write seed checks like that. There's no approval. The better ones will, the partner can write 250 checks. I mean, they can do maybe 1 or 2 a year with no diligence, basically. And so they'll do that. They'll throw those out as placeholders. And the hope is that maybe 1 in 10 becomes something they'll invest in at the later stage. But if they're going to put a later stage check in of $5 million, they're going to have a whole philosophy around what they look for there. And so it's more balancing a portfolio across stage. In fact, a lot of VCs will show you, I mean, if you look as a potential limited partner, they'll show you a formula. Let's say, we're going to raise $50 million, $40 million are going to be average, to this many companies at this average rate. And then $10 million is going to be this many companies at this rate. They'll have a whole formula for how they do it. And that's their plan, for investing. And so that's the way in which they tend to balance it out.
Thank you.
Yeah. And Joseph, you had a question?
Yeah, I just want to ask you, you made a comment earlier about VCs kind of crushing companies by forcing them to spend the money quickly, right?
Yeah.
I understand. I've been on the inside of a lot of startups, and there's a pressure to hit KPIs or certain metrics. How do you balance the two, right? Like, you need to spend money to make money, and spend it smart. But there's sometimes, companies are just being pushed to spend the money, like you said, at any expense. And we saw this years ago with, these ridiculous cost per acquisitions, and some of these companies are now gone. So I'm just curious what your thoughts are on that.
Yeah, no, I think it's a horrible mistake to basically make business decisions purely based on, what a VC who probably has very little real operating and strategy experience in the area is pushing you to do, is a really bad thing. And I've seen that, all too often, where look, if you're signing on to start and be CEO of a company, what you do is make those strategy decisions. And so I mean, that's what you're doing. You got to do what's best for the business, what's best for your customers. Investors may provide constraints on you, but to expand faster than you're able to, that's one of the biggest causes of failure of startup companies. In fact, if there's time, I'm going to talk a little bit about the 8 patterns of failure, and that is one of them. 6.
I liked your point there about the VCs not being in the operation of the business, but they do have these expectations, whether they were set during the fundraising round or some presentation that show we're going to grow X%. So there's this pressure. I'm not sure who's putting the pressure in, but I think it's an interesting comment you made.
Yep. Joseph?
Yeah, I had a quick question about, your comment earlier in the talk. You said you had found like ERA and some of the other sites less useful, the accelerators. Just wanted to get your thoughts on why that was.
Why don't we come back to that? Let me make a note of that. Why don't we come back to that one? And I'll hit that a little bit after we finish some of the material. And Ian, did you have a question too?
Yeah, well, I apologize because I came in a bit late, so I don't know if you already covered this, but deployment of capital by VCs has dropped very significantly over the last year. Has the same been the case with angels?
Yeah, the recent data is it's fallen off. I have some slides on it at some point, but it's going to fall off. It's pretty cyclic, and so the VC fall off has been much greater percentage-wise.
Okay,
and it's been more skewed to the later stages because the IPO market has dried out.
Got it.
My angel groups are deploying capital at constant rates. I mean, we haven't changed, and so,
all right.
That's kind of interesting because there's still opportunities out there.
Great, thank you.
Okay, let's move back on track. So how do investors make money? It's going to be through exits. And so people talk about, many companies, and so you really need to be aligned on this with your angels and your investors. And you basically need to talk about your exit plan. It may be a bit of therapy, but this is the consequence of taking outside capital. If you want to be one of those entrepreneurs that, our company bought out, a couple of decades ago, and live a lifestyle business and wait and sell, when you decide you want to retire, that's your prerogative. If you're going to take outside capital, your outside investors are going to want to have an exit. And so you need a plan, and you want to be able to articulate that. Most exits are by acquisition. 90% of exits of kind of early stage companies are through M&A, not through IPOs or secondary sales. So that's the reality of it. So, it's a bit of a complicated chart, and it takes a while. So this is from Texas Coast Angels. It's a lot of data. It shows how many years to get a resolution. And what you can see is that most outcomes happen. The mode is year 3 where they had, and it declines after that. The losses tend to be in the early years. That's all the red ink. Year 3 on average is a bad year historically for their investment portfolio, but the green is pretty much spread out. And so I think we're not talking about VCs, for angel investors that know to invest with patience and don't have timeframes necessarily that they're accountable for, then this is the pattern that they pretty much do experience. And so you really got to ask yourself, who would buy your company? And in particular, what are your target metrics? Consumer goods is a really good example. I like to invest in consumer goods companies. It's my background. It makes a big difference, though, when I have an entrepreneur that basically says, we've studied this category. This is the pattern of exits. We need whatever, $25 million of revenue and 5% margins or whatever. When they have a clear view on the repeat numbers and the metrics they need and who the potential buyers are, that gives me great reassurance that they understand the industry and they know what they are doing. And I remember, just as a one side anecdote, a friends and family investment I made with actually a high school or a grammar school classmate of mine. He started the company and said, I think Bausch and Lomb is going to, if this works, they're going to buy us. It may take 8 or 10 years, but they're going to buy us. And guess what happened? It took 8 years and Bausch and Lomb bought them. And so, a good entrepreneur knows exactly what they're doing. And in fact, that is what I saw a lot on the corporate side, is a lot of entrepreneurs that knew exactly what we were, a big publishing company, exactly what we were looking for in terms of, medical publishing or legal publishing. They had a really clear idea, and they were usually right. And we would follow the companies for years until the entrepreneur decided they wanted to sell. And so you want to flip that around as an entrepreneur and think about building the company for a target acquirer. Do not make the mistake of building a company for Google or Facebook or Amazon or any of the behemoths, because, that is a real red flag to an experienced investor. Yes, they do make acquisitions, but I have never seen a company start with Google as the acquirer and have Google ultimately buy them, because that is really pretty rare in terms of playing, the numbers. You've got to have a much better focus on who your acquirer would be than thinking one of the big behemoths are going to pick you up. Yep,
Can I ask a question?
Yep.
Okay. What about for us, we've had a close relationship with Realtor.com. In fact, the head of rentals is a personal mentor of mine, and he got there through Realtor.com acquired their company. We've been putting on our deck that we can look at them acquiring us in our space or IPO. And the reason why we say IPO is because I just know in our market, things are just geared towards the landlords only. And then like it gets acquired and they find out it's a ghost platform because it has nothing in it for the students of the college. Is it a red flag for, you know, many VCs that there is a delineated strategy between people, these groups could acquire us, but we would rather IPO if it was best for our company? Is that a red flag for seasoned investors?
Yes, that's a big red flag. I mean, ideally you want two bidders and you want two corporate bidders, or at least two bidders. The only way to get a good exit is to have a bidding war amongst two likely acquirers. The IPO market turns on and turns off. It takes absolutely forever. And frankly, the companies that I've invested in that have exited via IPO, it isn't great. I mean, yeah, it may be, you know, at the moment of IPO, it looks great, but then a couple of cases, they just get beaten up in the stock market afterwards. And, you know, the market is absolutely so fickle for early stage companies. And so, I mean, frankly, a couple of companies have just basically ultimately been money losers, even though it's been an IPO. And so the best acquirers have always been, in my experience, a case when you've got multiple strategics that are bidding against each other. That gets the best, the best price. And so, yeah.
Okay. And, you know, I might have raised money. I have a company, but like, you know, I'm not the most seasoned person on exits ever. So that's why I'm happy.
I understand. Yeah. No, I think so what you just may want to start thinking about more strategics as an exit. That's kind of the message. You just think about trying to, over time, you know, cultivating buyers, building relationships, to the extent you're going to steer, you know, look, the one thing I learned umpteen years ago, the best entrepreneurs build the company to operate, but ultimately to exit. And they have a very, just like my friend did, he knew what Bausch & Lomb wanted, and he built the company so that Bausch & Lomb could buy it, and hopefully all the Bausch & Lomb competitors would be bidding against it. And that's exactly what happened, you know, in the end, and it was a great exit. And so that's that. Yeah. Okay, what do we? Okay, one of my favorite topics, valuation and terms. Is okay, let's go to the data, okay, and bear with me on this chart because it's not going to be what you're going to read in TechCrunch and elsewhere. So this data was just released. It was actually released in response to a bunch of press that talked about how safe investments are taking over the world. And this is from the Angel Capital Association. Most angel group investment is preferred stock. So most angel investment qualifies as a seed or Series A round. And in those rounds, look at seed rounds, about half, 48% is preferred equity, 36% is convertibles, only 12% are safes. And then when you get to Series A investments through angel ACA member companies, it's 76% preferred equity. And safes are only 30% in pre-seed, but that actually qualifies. I mean, their definitions of rounds, that's more like an angel round. That's a very small percentage. And so, you know, the people that send data to TechCrunch and Crunchbase, that's not, you know, most angel groups are not submitting their data. They do submit to the Angel Capital Association. And this is a much better reflection of what's happening in the world of serious angels, where preferred equity is the preferred format, then convertibles after that. Let me talk about preferred equity and what's different about it and why serious investors look to it. First is guaranteed follow-on rights. And experienced angels know that if you have a hot company and it takes off, the VC will deny follow-on rights to any other investor that's not writing a significant check. They'll probably establish a minimum of 100,000 or 250, and they'll just shut out the angels. And so it doesn't happen when the company goes sideways. It doesn't happen when the company is progressing normally. If the company takes off, then angels would just get shut out. And so to any serious investor, you've got to basically follow on to your winners. And so that is a formula for disaster and negative financial returns. And so if guaranteed follow-on rights is really critical to any serious investor. Same as information rights. And here we're not talking about the ability to study your books. We're just talking about getting annual and quarterly financials that VCs will shut angels down if these rights are not guaranteed. And so that's why experienced angels, they want to just be able to follow the progress of your company. That if you're going to invest at the early stage, I think that's a right that they should have that can't be taken away. Third, I don't know how many of you are familiar with what Section 1202, otherwise known as the QSBS, the Qualified Small Business Exemption. It's the only investment protection offered to early stage investors in the US tax code. If you invest in a C Corp, the first $10 million of gain after a 5-year hold is exempt from capital gains tax. It's got to be a stock investment, not a note, and the clock starts ticking when the stock investment is made. And so any angel that has any experience in doing this realizes that, you look at that chart, sometimes it's more than 5 years, sometimes it's less than 5 years. It's really critical that clock start ticking as soon as possible, because the last thing you want is to be paying capital gains on the exemption. And a proper preferred equity round, almost all the law firms today will put a paragraph in there that says QSBS. This investment is a qualified small business per the IRS tax code. And so any serious angel, they want that documented at the time of the investment, because they may very well get audited. And that's their defense against a stock audit and their ability to avoid capital gains tax. And so this is not well known. A lot of people that are writing checks, certainly friends and family, aren't aware of this. But it is a pretty key item that serious angels care about quite significantly. So convertible notes, you're pretty familiar with, but the typical format is it's going to have a cap. It'll have a discount. It'll have interest. It's got pretty expensive legal fees, but they do lack those investor protections that I just went through, that a preferred equity around. They can be easy to do. A lot of groups now will have side letters that will grant them preferred follow-on rights and info rights, which help eliminate the disadvantages. But notes are really very common. But then you get to these things called safes and kisses that Y Combinator has. A safe isn't debt. There's no interest, there's no maturity, and there's often no cap, any discount. They've got significant disadvantages, and a lot of investors will just not go near them. Or these days, they'll insist on having a side letter that'll help eliminate some of the negatives associated with safes. And so to come back to that question I put a pin in on, one of the reasons why the incubators have become much less of a source for serious angels is that safes have become the common format for raising capital for companies coming out of the incubators. And it's just, it's a bit of a gold rush for investors. And so the sophistication of investors that are investing in companies coming out of incubators has dropped. And so it's a reason why those are less of a valid source for experience. Angel.
Can I ask a question?
Sure. Yep.
Okay. So, and I would say I'm sorry, but I'm not sorry because these are real questions from a real entrepreneur. So I'm not sorry. Actually, I'm asking you questions. So,
no, I said I'd be saying things that you are not going to be what you're hearing from other people. So I'm happy with that. Fine with that.
So we've been working with a pretty well-known incubator, and we've worked out that we're targeting to raise $1 million in our pre-seed round. We've raised about 194,000 in our friends and family round, 100,000 in our convertible note, and 104,000 in our convertible note, and 90,000 in grants. We were a Techstars finalist earlier this year for New York, Chicago, and Oakland, and they were like, just come back to us in a couple months. We want to see a little bit more of your guys' initial go-to-market traction because you guys have more of a seasonality to this business. But in our raise, would I count Techstars money as part of that $1 million raise? And internally, personally, I would say no, because they're taking like that 7%. And if I'm raising $1 million, if one investor is taking 7% out of 120,000, only at 120,000, that would deflate the $1 million raise, because at the stage we're in, to say, you know what I mean?
Yeah, I would certainly not put it in the same category. The incubators will often look at their investment in kind. I certainly would not count that. But look, a lot of the incubators are making formulaic investments in the round that are chump change for them because they're getting so much equity. It's more like a sign of good faith, and it's done because they sort of have to from a marketplace standpoint. And so, yeah, I wouldn't really count that quite in the same bucket.
Okay, so that goes to my thought of, do we even need a group like Techstars in this raise? Because we already have contracts that are worth $1 million.
Look,
we already have these things.
I think the big question for any investor, and look, I was an investor in some of these accelerator platforms ages ago. They're going to take, it's expensive. Incubators are expensive. They're going to take, as you said, 7% or plus or minus of your stock at a valuation you'd never take outside capital at a crazy valuation when you look at the math of that. And so, yeah, you're going to get advice. You're going to get, you will get advice. You've got connections. There's pluses. And I think you've got to really weigh it very carefully as to whether or not you really need that. And so, I think if in general, for inexperienced entrepreneurs and ill-formed ideas, it is one way to kind of, that may be worth 7% to try to get more experience and advice. But I would say this, there are also many of the universities will have incubators that will coach alumni companies and will take nothing. And so, if you have a connection with a school, you may want to look into, one of them. Obviously, Harvard is really unique, but they have the iLab at Harvard, and they have the Rock Center, both of whom have got pretty extensive programs. And if you've got one member of your team that's HBS or Harvard, you can probably qualify to get in there. But, that's basically free. But, Techstars and the others are going to be pretty expensive. Anyway, just back on safes. I don't want to beat this. I'm happy beating it. I don't want to beat it too much. But the ACA just came out with this statement on safes, recognizing that how popular they have become. But what they're saying is that the pricing round, the clock on QSBS is pretty important. The investor protections, which often can help management, is pretty important. And also the governance, which I kind of glossed over. But when you do an equity round, you're going to form a board of directors. And I would say most entrepreneurs will benefit from having a formal board of directors in terms of governance, in terms of direction, as well as accountability that will help with exits. I won't go through this in detail, but just some of the conclusions from the Boston Angel Group Launchpad. They found their returns were really much lower on notes and safes. And the main reason was that 44% of note rounds were followed by another node. So what happens is you tend to see excessive fundraising. And so it clocks their returns to half on what they got from equity investments. And so even they were kind of blown away, as they said. In their conclusion, no offense to people that have real cancer, but safe notes are the cancer of the investing world. One way to think about this is as you move from safe to debt to stock, you're actually opening up the world of investors, certainly the world of sophisticated investors. So a proper preferred equity round with good protections, any real investor will favor that. And so, yeah, look, and you can probably get a lawyer to do that for $25,000. It may be a little bit less expensive than some other formats, but it does have a big, big advantage. Anyway, I'm just looking at the clock. Let me try to move through some more material here. That when you get to valuation, who cares about valuation? This is another important point. You do, experienced angels do, and the seed VCs do that are putting a lot of money into the round. But who doesn't really care, and who friends and family don't care. Series A and later VCs don't care because it's just a placeholder. The incubators really don't care about valuation because they have the equity. And a lot of angels, either the new angels or the angels who are just looking for billion-dollar exits, they don't care. And so you've really got to ask yourself, if someone is going to be a lead and set the pricing on the round, is it someone who cares or doesn't care? And as an experienced angel, I can always tell when you have a valuation that is inappropriate, how it got set. And that often leads to, to problems. Here's current data on valuations, just so you can see. The median valuation for seed rounds, and this is both VC and angel, it typically had been about 5 to 6 million for years, and it's clicked up in the past couple of years. The biggest click up has been the 75th percentile, which is up to 18 million. And what you have right now is this is the bubble that exists, and whether this is it's begun to come down and has got a long way to go. And so you just as you look at your own valuation, realize that you'll see some larger numbers, but this is quite a bit of a bubble, and it's really unclear whether that exists or not. It certainly varies based on company and circumstance. Okay, a little bit on valuation with some real numbers. And this is really rough based on kind of my own experience. But if your pre-business plan, a lot of angels will look to a $3 to $4 million under 5. If you've got an MVP, that may click your valuation up to 5 to 7. If you've got recurring revenue, then maybe you can look at something that is over that 8 to 9. And if you've got real product market fit, that's probably more like a Series A, then you're looking at over 10. Again, take this advice or don't take it, but it's the way a lot of...
Can I ask a question here?
Yeah.
So for each of these, this is considered the valuation roughly, and what are the typical raises to get to these valuations? I know that that's different in every situation, but
typical rounds will typically be about 500,000 to $1 million.
Okay.
Most my angel group, particularly New York Angels, if anything, they're almost always encouraging entrepreneurs to raise more money these days, because you want to raise enough money to last to the next funding round. In fact, actually is the next, the next chart.
I was going to ask that in terms of, it seems like the number of pre-seed seed has gone up recently.
Yeah, that I don't know. The terminology is, I don't know. This terminology is, let's not get too hung up on it. Which is, you'll do your friends and family round, the first outside funding when you're raising money from strangers, you call it pre-seed or seed. That's really what I'm talking about here. And so the message here is that a lot of angels see this as two options, only two options here. Either you're going to raise enough money to be done, basically, to get to break even and not to have raised money again, or you're going to raise enough money to get to a Series A. And that requires an understanding of what the metrics are that VCs look for in a Series A round and have a good understanding of that. And what is a red flag is anything in between. I want to raise money to build a product. I want to raise money to test the waters. I want to launch a beta. I mean, that is not an acceptable answer. And a lot of experienced angels will not sign on to a round like that because they know it happened through COVID. You're going to run out of money and you're going to be right back asking for more money, and because you didn't raise enough money, and they really want to avoid that. They want to fund you till you get to your next milestone and not have to do emergency funding, which could be a down round.
Okay, well, we heard about a $1 million pre-seed raise. That sounds like a lot for a pre-seed to me, but I guess the numbers are shifting upward.
Yeah, again, I don't know. I mean, pre-seed, seed. I mean, I'll certainly speak for, you know, what I've seen coming out of a group like New York Angels, which has got a lot of capacity. This is the way they look at it. You know, they'll put $1 million into a company and they'll push you to raise more, and they'll help you do it. They'll push you to raise more money and help you to get there if they really believe in you. But underfunding is too many companies went belly up during COVID when the funding pretty much shut down, and there were too many emergency funding rounds of companies that just ran out of money. And anyone that's been investing through that, and you had to make a choice. You put money in to help a company in distress, or do you let them fail? It's a tough, you know, it's a tough decision. And a lot of people learn that you don't go into a situation with an underfunded company. Let me skip because we're running out of time, and talk about a couple things I'd like to emphasize. So first of all, what's important when an experienced angel looks at entrepreneurs, success is really important, a track record of success. And HBS has got a pretty clear definition of success for an early stage company. Did the early investors get back more money than they put in? And the reason is you can always do a recap, a down round. And again, it happened a lot during COVID. Companies did a reset, the angels got wiped out and they raised more money. And you really want to avoid that. So that's not a success. And so the reason why it's important is the data is pretty clear. Success breeds success. If you're a first-time founder, on average, it's a 21% success rate. If your first time was a failure, it doesn't really change much. If your first time was a success, given this definition, then you get about a 50% boost in your success rate. And so if you made money for your angels, you're likely to do it again. And so when you pitch, you know, to me, if someone says they're a repeat founder, that's not necessarily a positive to me. The question is, did you raise money and did you make money for your angels? That's what I look for in founder track records. That's the only signal that matters to me when it comes to repeat entrepreneurs. So why do startups fail? I'll run through this real quick because we're running out of time. I encourage you to get this book by Tom Eisenman. It's available on Amazon. It's called Why Startups Fail. And it's extensively researched. And he found 6 patterns of failure. 3 of them and he taught a whole course on this for a number of years at HBS. The big patterns at the early stage, number 1, he called good ideas, bad bedfellows. You don't have the right team. A lot of first-time entrepreneurs will move into an area because they want to be entrepreneurs, not because they have experience in it. The smart ones will spend a lot of time compensating for that and building a team of advisors, employees, investors around that to compensate for it. And that is that hence, if you don't do that, that's a real pattern of failure. Second, you've got to have a successful minimum viable product before expanding. And there's certain definitions for that. I talked before about VCs and investors pushing companies to expand too quickly. You can read HBS case after case of companies that expanded too quickly. And I could give you examples from my own portfolio of cases like this, companies that expanded too quickly. He calls that a false start. But then there's also something related, which is false positives. which is success with early investors is not necessarily repeatable success. You have to understand early adopters will have certain criteria, and you can misread that to be the vast majority of the marketplace, and that is another real pattern, of success failure. At the later stage, Tom's 3 causes. One is just not having the right capital, the right capital or the right talent to be able to proceed. It's mostly not having the right team to be able to expand, because the team you start with may not be the team that you grow with. And so that's pattern number 4, growing too quickly. As you put more money, particularly in any kind of digital startup, if you're doing any kind of digital marketing, your marketing ROI is going to decline as you expand. And a lot of people don't put that into account. Often they'll expand too quickly into many geographies where they should be focusing on a test. I can't tell you how many entrepreneurs I've counseled to I'm not going to invest until you get your first market right. And I see a business plan where companies that are multi-local are expanding too quickly. That is a huge disaster plan, where companies will move into other markets before they're ready to do so. And then finally, moonshots, failed moonshots. Companies with big aspirations to go IPO, to try to do everything. And, those things tend to fail more than once, because you can't do it all at once. It's just too difficult. So anyway, get that book. It's got some very good lessons, lots of cases, and I do encourage you. And then let me just give you 5 tips, and then we can wrap. First, be sure you know your audience. I'd mentioned this before, but don't waste time with investors, be they VCs or angels, that are kind of out of your target area. Stay in their zone, and just don't waste your time or their time pitching too hard to get someone that really is outside of their own investing zone. Second, it's really critical, particularly in a pitch or in any interaction with any VC or angel. You really got to sell them twice. You got to sell both sides of their brain. You've got to make them really want the company. Sell to their right brain, their imagination brain. Make them believe the company is great. It's a big problem, and you've got a great solution. If you're selling like a food product, they make it literally, have them taste your product, and they better love it, because that'll get some emotional attachment. But then you've also got to sell the left brain. You've got to be prepared with answering the likely questions. You need to anticipate it, and you need to make it easy for them to go with their gut. And this is absolutely true with VCs. And you'll find, because VCs it's not just an individual, there'll be a decision-making group. And so, one partner may love it, but he has to sell, or she has to sell the other partners who are going to do all the analysis, and they're probably delegated to an associate that's going to want to crunch all the numbers. And so you've got to have all that stuff together too. And it's not an either or. They're going to both be important. Which is why before you start reaching out, you really want to get all your ducks in order. And I like to say you need three kind of pitches in order before you start spending time reaching investors. Get your quick elevator pitch, that short, succinct explanation, which makes people want to, makes their mouths water. Have that short pitch deck that really works, but then be really ready with your diligence so that you can answer all those questions. You've got the data room ready. The last thing you want is to get anyone, an angel or anyone, excited about your company, and then they say, well, can I see your financials? And you make them wait 2 weeks to get the financials. You lose all the momentum that way. And so raising capital really is a matter of getting the heart and the mind of the investor together and getting that click. Fourth, I really encourage you to deal with your warts up front. Honesty is better than sugar-coated bullshit. It's fine if you've had, you have something in your background that you're not proud of. If the company has got some issue, please put that out there fairly early, not necessarily in the first 5 seconds, but don't, if the Investor finds something out later that's unexpected. The key thing is investors want credibility. You're going to lose credibility. And so, and that will kill things, pretty immediately. And so, you really want to get any issues out there early in the process and just deal with it up front. It's much better off than dealing with it later. And then lastly, be sure you keep up with your investors, update them, and let them help you. I mean, the best entrepreneurs I know will send out updates every month or every quarter, and the end of every update is always the same. Here's our ask. And they always have an ask every single time, and they're always going to get feedback because you want to help the company. You can, and often they want a connection here with this industry, with this country, with this company. So, put your ask out, and that makes it very, very useful. Anyway, let me cut the slides off and see if there's any questions I can help answer, time permitting.
I have a couple of questions. I'm sorry. Yep. Do you think an executive summary is important as well?
No.
Oh, okay.
No, I think you need those three formats. That's what I think is important, honestly, is, you want that quick pitch. That could be an executive summary, but it really should be something that you can just come out of your mouth really quickly. If you, look, everyone's presentation that's a whole nother topic. Presentation style is going to be very, very different. You want to, I would say this, you want to open every pitch. You want to get the basic heart of your concept out really, really quickly. And so if that's an executive summary, that's fine. If that's your elevator pitch, that's fine. But you really want to hit so you want to get them to want your company in the first part of the pitch. And so that's really what's most important, as opposed to having kind of a standard executive summary. So maybe it's yes and no, depending on terminology.
My second point was, would you send me your deck that you just shared, and can I share it with the attendees?
Sure. Yep. I can send you a version of it. Yep, we'll do.
Okay. One third thing I want to say, why startups fail. I wrote a newsletter editorial about why one of the main reasons why startups fail, and it's not on anybody's list of 10, 12 reasons why startups fail, because founders don't listen. You find that that's
well, I mean, the thing I like about, and in fact, I know Professor Eisman well. He's a former colleague of mine from years ago. Look, startups fail because they run out of money. It's a simple question. Every company fails because they run out of money. Like, why do you die? You die because you're brain death.
That's not true.
That's not really helpful.
My sister's a doctor. She said everybody dies of a heart attack. They die when their heart stops.
Yeah, your heart stops and your brain stops. I mean, that's exactly. So, startups die because they run out of money. That's not really helpful. You can think you're a finance expert. I'm never going to run out of money, but the reality is, running out of money is a byproduct of some of the 6 patterns that Tom talks about in his book, and that's really the underlying. I think those are pretty good comprehensive review of the underlying reasons.
Does anybody else have questions? I didn't mean to monopolize.
Yeah, I'm on the website for the Harvard New York chapter, and I see that there's a place to apply to pitch. What can I say or put in there to get accepted and be able to present in front of people?
Look, the main thing is just, we're a large, diverse group, and the way it works is through the GUS platform. Every member rates and reviews companies. And so, and every member is going to have their own what sector, people are going to put their sector filter on it. I think the main thing is putting together a complete application.
That's for like a business plan. Do they want the full business plan, like 30 pages?
Well, yeah, absolutely. They want the full pitch. It's very helpful to update. There's a section where they want to have financials put there. If you have our investment terms, I'd upload your note or your term sheet, and just fill out all the different aspects of what's asked for you there. Okay.
Do you know anything about the acceptance rate?
Yeah, on average, we get about 20 companies, 25 companies, 30 companies that apply every month, and we invite 5 to pitch. And we invest in about 1 to 2 per month.
Okay, and then, so the other ones are still in the portal, people could still look them up, but maybe they're not going to the event, or it goes away?
The application is active for 2 pitch cycles.
Okay.
And so you'll get, if you apply, you'll get a note that basically says, people are gonna rate and review, and then if it's not accepted after 2 pitch cycles, occasionally we'll keep something around for a 3rd, but usually you'll get a turn down letter at that point.
Okay, and then average investment size, do you guys have a range?
Average last year was about 250. It was high year because there was a lot of follow-ons. So 150 is more typical. The an average check is 25,000, basically.
Okay.
Yeah.
Cool.
Yeah, quick question. I mean, our term state safe is our kind of preferred approach. So from what you said, that probably wouldn't be a good idea if we're applying to HBS Angels.
Correct.
Got it. Okay, that's good to know.
A lot of investors don't like safes. Another person who came up with the idea was actually Adeo Rasay. I don't know if you know Adeo or not. He founded Founder Institute, but he was early in. But he said it was supposed to be a very limited use platform. He developed it with Wilson Sonsini, I believe.
Yep.
And for some reason, everybody started using it.
Yeah. Look, and I can tell you that from my experience, as an angel, I expect to have companies fail. So that doesn't surprise me. I don't want it. What I get disappointed is when I have an exit and the exit multiple is less than I think it ought to be. And in every one of those cases, it has a lot to do with governance and the fact that you've got, and there's been inadequate governance, the inadequate representation of the early stage investors in governing the company. And the company's made decisions that have cut the return for early stage investors. It's one of the reasons why I will not do a safe without governance, because it's exactly what Launchpad said. Basically, is you tend to see excessive dilution and preferences. And one of my exits out of ERA, the company did great, and then 9 months before exiting, they took another round from a VC who put through a 2x preference. Well, they reset the price high, and the 2x took all the profit out. So I was an almost 10-year investor, and I got my money back and maybe a little bit, but the VC basically doubled his money in 6 months, and that's not the way it's supposed to work.
No. So I know we're running over. Anybody else have any last questions? I don't know if you want to put your contact or give your contact information, Jason, but I always do ask.
Sure. Yeah. No, just Jason at ongridventures.com is the easiest one.
Can you repeat that, please?
Jason at OnGrid Ventures.
Thank you.
Anybody else? Thank you. Thank you so much, Jason. I'm sorry we didn't get time for more Q&A about you, but we'll have you back again. Don't worry.
Okay, great. Thanks, everyone.
Thank you so much.
Thank you.
We'll be back in 2 weeks, and have a great day, everybody.
All right.
Thank you. Bye-bye.
Thank you all. This is very valuable. Thank you.
Oh, good. Thank you. Thank you for being here.
Oh, my pleasure. Thanks.
Okay.